So if you're a company director, you need to hear this. The UK is heading into a period where tax isn't going to feel fair anymore. I mean, it's never really felt fair in the first place, but it's going to get worse. Not because rates are going up, but because the government is running out of money in a way that most people don't even understand. And when a government can't grow its income fast enough, it doesn't cut spending, it shifts the tax burden onto the people it can monitor most easily. That's us, limited company directors. In this video, I'm going to explain why the UK's finances are in this position, why directors are first in line for the squeeze, and the exact structure you need to consider if you want to legally protect your income without leaving the UK, without breaking any laws, and without doing anything aggressive or risky. And I'll say this now, the structure I explain at the end is the same structure used by large companies, private equity firms, and high net worth clients every single day. It's just that nobody teaches small business owners how to do it. So stay with me, because once you understand this, you'll never look at your business the same way again. The whole problem in plain English. Most explanations of the UK's finances are full of jargon, politics or blame. So let's strip it back to something everyone can understand. The UK has money coming in and money going out. Money coming in is tax. Money going out is things like the NHS, pensions, benefits, public sector wages, schools, infrastructure, foreign aid, debt and interest repayments. And here's the key thing most people miss. Those costs rise automatically every year. Even if the government does nothing, more people retiring, people living longer, healthcare costs rising, more complex public services, and inflation on top of that. Meanwhile, tax income isn't rising at the same pace because the economy isn't growing fast enough. So the gap between money in and money out has to be covered somehow. And for the last 15 years, we've been covering it by borrowing. Not small borrowing, hundreds of billions. And borrowed money isn't free, it has interest. And right now, the UK is paying more in interest on its debt than it spends on transport, housing, defence, and almost anything except pensions and the NHS. We're basically using today's tax to pay for yesterday's decisions. That is the core problem. When a government can't grow fast enough to pay for itself, it starts looking for the most reliable taxpayers to lean on. And that's where we come in, directors. Not billionaires, not global corporations, us. Because we're easy to find, easy to audit, and easy to squeeze. Stay with me because the way they do it is subtle and almost nobody notices it until their take-home pay drops. Why directors are the ones who get hit. Here's the part most people don't realise. When the government needs more revenue, it's not looking for the richest people, it's looking for the most predictable taxpayers. And that's directors. Not because we earn the most, but because the government can see every part of how we pay ourselves. If you're a director, your entire financial life is already recorded at Companies House, filed with HMRC, connected through your PayPal, Stripe, like online processors, linked to your business bank, and tracked through digital VAT and MTD reporting. You are fully transparent to the system. Compare that to global corporations who move profits internationally, ultra high net worth individuals who relocate their tax residency, and PAYE employees are already maxed out. So when the government is looking for more money, it goes to the group that can't easily avoid being seen, and that's you. Here's the key point. They don't have to raise your tax rate to take more from you. They just freeze thresholds, reduce allowances, change how dividends are taxed, tighten compliance rules, and expand reporting requirements. It's quiet, it's gradual, and because it feels technical, most people don't even notice until their take-home pay has already fallen. And that's why waiting until the budget is announced is too late. The people who come out of this fine are the ones who structure early. Not because they're avoiding tax, like many of the people in my comments have been saying, but because they're planning for how tax works. And that's what we're going to get into now. Step one of that plan. This is your operating company, the engine. Let's start right at the foundation, your trading company. This is the engine. It's where the work happens. Invoices go out and money comes in. If you're a content creator, that's your ad revenue, sponsorships and brand deals. If you're a consultant, it's where your client retainers and projects are built. If you're a contractor, it's your day rates. That's your service, the part that generates cash, but it's not your safety net. And that's the mistake most directors make. They start with one company, and as it grows, they just keep using it for everything. Trading, investing, personal drawings, all through the same single story limited company. It works fine until something happens, and that's what caught so many people out during COVID. When lockdowns hit, when contracts froze, when invoices stopped getting paid, they had everything tied up inside one business. Their trading company was their income, their savings, their security, all in one place. So when that one entity stopped trading, everything stopped. If every single director had taken a multi-layered approach like the one I'm showing you here, a trading company for operations and a holding company for protection, they would have had something to fall back on, a buffer, a financial bunker, a plan B. If we learned anything from COVID or even from the 2008 crash, it's that you have to plan for the worst case scenario while you're doing well. That's what big firms do instinctively. They separate what earns from what preserves, what risks from what protects. Because when you put everything in one pot, you're saying, if this goes down, I go down with it. But when you build layers, you create firewalls. Your trading company becomes the engine, it earns the money, then you move the profit up to the holding company. That's your vault. That's where you build safety, wealth, and options. Think of it like this. Your trading company should be lean, fast, and replaceable. Your holding company should be untouchable. If the bottom floor floods, your money should be on the next level up. That's how serious directors structure, because they know growth means nothing without protection. Next, the holding company, the vault. So once you've built your trading company, you need the vault that protects what that engine produces. That's where the holding company comes in. Think of it like another story to your financial house. The trading company lives downstairs doing the messy day-to-day work. The holding company lives upstairs, doors locked, lights calm. It's where the wealth sleeps at night. Here's how it works. Your trading company pays intercompany dividends up to the holding company, and in most cases those dividends are exempt from dividend tax, meaning no extra tax when the money moves between the two. It's only when you eventually draw it personally that you trigger tax. That single distinction is everything. When you take dividends personally, you pay the tax immediately. End of story. When your company takes the dividend, you've kept the money inside a corporate wrapper where it can still be used, reinvested, or parked safely, and you choose when it becomes personal income. That's how you move from being tax reactive to tax strategic. Inside the holding company, you can build up cash reserves for stability, your COVID fund, quiet month buffer. You can buy property or assets, keeping them ring-fenced from trading risk. You can invest in other businesses or funds, lend money back down to your trading company if it needs liquidity. Every one of those steps keeps money working, but safely above the risk line. Remember, the trading company can fail, be sued, or go through a dry spell. The holding company just holds. It doesn't trade, it doesn't carry the same risk. It's your clean entity. If the worst ever happened, a lawsuit, an HMRC investigation, or another economic shutdown, your trading company will take the hit while your profits, property and investments remain protected upstairs in the holding company. This is exactly how big firms and private equity groups operate. They never have just one company doing everything. They've got layers because they know business is unpredictable. And the real power is this. You can scale horizontally. That holding company can own multiple trading companies. One for your service business, one for your content brand, one for your property ventures. Each one ring-fenced, but all feeding the same wealth container. That's how you build resilience, not just revenue. When directors understand this, they stop thinking like employees and start thinking like asset managers. And that's when wealth stops being luck and starts being structure. On my Reeves budget video, people kept commenting saying, you're just scaremongering. Well, yeah, I am, because you need to wake up. Look at what's actually happened in our lifetime. VAT climbed from 17.5% to 20%. Corporation tax rose from 19% to 25%. National insurance went up this year. Dividend allowances have been slashed again and again. Employer pensions, the government quietly shifted that entire cost onto small businesses, and now we're hearing whispers about more increases. So yes, I am sounding the alarm, because the pattern is obvious. Every time the Treasury runs low, it moves the goalposts, and small business owners are the first to feel it. I'm not being negative, it's pattern recognition. If you've owned a company for more than 5 minutes, you've watched this cycle repeat over and over again. And the directors who didn't prepare lose another slice of their take-home pay. The economy won't save you. Your accountant can't reverse policy. The only person who can protect your income is you, by preempting the next move, not reacting to it. So call it scaremongering if you want, but when the next dividend cut or threshold freeze lands, you'll realise this wasn't fear, it was a warning from someone who's tired of watching small businesses pay for everyone else's mistakes. Now let's talk about how you can actually protect yourself from all that, legally and strategically. Right, so we've built the engine, that's your trading company, and the vault is your holding company. Let's talk about the part everyone cares about most, how you actually pay yourself and build wealth at the same time. Because most directors either strip every penny out or leave it all sitting in the business doing nothing. Neither is strategy, this is. Salary and dividend mix. You should pay your salary from your trading company, that's the one actually doing the work. Keep it small around the personal allowance, that keeps your national insurance record ticking and qualifies you for state pension years. Then, when your trading company's made its profit and paid corporation tax, move those funds up to your holding company as dividends. They are tax-free between the companies. From there, take your personal dividends out whenever it makes sense, time it around the thresholds, keep it efficient and stay in control. The next step is your employer pension contributions from the trading company. This is where most directors leave thousands on the table. You can make employer contributions up to £60,000 per year directly from your trading company. And that money is a fully deductible business expense. That means if your company makes 100 grand profit and pays 60 into your pension, you'll only pay corporation tax on 40 grand, and that's about a 15 grand tax saving straight away. Plus, you've moved 60k into your personal wealth tax free. That's not a loophole, that's how the system was designed. HMRC literally incentivises business owners to save for retirement this way. If you move profits upstairs to the holding company first, those funds are post-tax, so you'll lose that relief. So always make your pension contributions from the trading company while it's active and profitable. The next step is relevant life policy, pre-tax family protection. Your company can also pay your life insurance as a legitimate business expense. No benefit in kind, no income tax, no NI. You're just protecting your family using money that would have otherwise gone to HMRC, and it's completely compliant. Next is directors' loans, short-term flexibility. If you need a short-term loan or access to funds, maybe for a deposit, investment or emergency, a director's loan lets you take money from the company without triggering dividend tax as long as you repay it within the allowed time frame. It's breathing room, it's not a loophole. You can use it strategically, but you have to keep it clean. It needs to be repaid within 9 months. Next step is moving retained profits to the holding company to invest. Once you've paid yourself and funded your pension, the profits left in your trading company can be paid up as a dividend to your holding company. This is tax-free between the companies. It's post-corporation tax. So now your holding company can invest it safely without the trading risk. You can buy property, build a corporate investment portfolio, fund new ventures, or simply build reserves for stability. Your trading company stays lean and agile, your holding company quietly grows wealth in the background. That's how you separate income from assets and how real financial freedom starts. Let's bring it all together. Here's the rules: salary and dividends, pensions, that's your lifestyle, retained profit in the holding, that's your legacy. You're not avoiding tax, you're controlling it. You decide when and where it applies while protecting what you've built. If you're ready to structure your company like that, book your free 15-minute director strategy call using the link below. We'll map your full setup, trading, holding, extraction and investment, so you can protect your income and compound your wealth the same way the big firms do. Because it's not about how hard you work, it's about how strategically your money moves. So that's how you protect your income, build real wealth, and finally get ahead of the tax system instead of chasing it. I'm Sarah Charlton, and contrary to the comments I've had lately, no, I'm not an AI, I'm a Geordie and an accountant who just happens to use tech and common sense to help directors keep more of what they earn. All the links I've mentioned, the director strategy call, my tax game plan and the last video, are all in the description below. If you found this useful, hit subscribe and watch the next video.